Welcome everyone. Chapter 1 in this course covers information about accounting, which is the language of business. In this chapter, we will cover basic accounting concepts and terms, which will serve as a foundation for the course. So when running a business, it is important to have good financial information in order to make effective business decisions. And this also applies to everyday life. It doesn't matter what your occupation is or what your pursuit is in life. You cannot earn a living, spend money, buy on credit, make an investment, or pay taxes without receiving, using, or dispensing financial information. Therefore, good decision making will depend on good information. To explain to you the concept of accounting, I like to share a video that I found in YouTube. This video provides a good summary for the concepts in this chapter and provides visuals for those that are visual learners. So I hope you find it useful.
What is accounting? Accounting is the language of business. Well, what is business? Well, you could say business is like somebody taking a hammer, building a house, and then taking his stuff that he made and selling it to somebody with money. Then they make their exchange and it's all good. Another way to look at business is that it is a magical box. You take raw materials, put it in the box, and then it comes out as goods that you can then sell and make money. That box is business. So let's say you have a business. You make something that costs you $100 to make and you sell it for $200. You have a profit of $100 and you're happy. I just told you a story about a business that made $100. So who should we tell our story to? You might want to tell your story to banks or investors. Banks or investors want to hear your story because they might want to lend you money or invest money in your business. Another person who wants to hear your story is Uncle Sam. He wants to tax you. We could break it down into 3 different people that want to hear your story. People on the inside, or internal users. People on the outside, external users, or the government. The language by which you tell these people stories is sometimes called managerial accounting for internal users, financial accounting for external users, and then tax accounting for government users. If you've ever taken an accounting class, it's usually going to be called managerial, financial, or tax. The actual language that external users want to hear your information in is GAAP, G-A-A-P, which stands for Generally Accepted Accounting Principles. The government wants to hear your story based on the Internal Revenue Code. That is the standard by which you must tell your story. Now, internal users, what's the name of the language that they want to hear? It's actually whatever you want. There is no standard managerial accounting language. If you're a business and you're talking to an external user, you want to look good or show that you made a high profit. Everyone wants to brag about how good their business is doing. However, when you talk to the government, your objective is to make it look like you made nothing. Because if you're rich, they'll take all your money. Now, if you're talking to an internal user, your objective isn't really to look good or to look like you made nothing. It's really just to tell it as accurately as you can, because that's the information upon which managers and decision makers will make decisions. Now, your story might be the exact same story in every instance, but depending on who your audience is, you're going to use a different language, and each of these languages will actually tell a different story, even though it's based on the same actions of the business. In review, accounting is the language of business. Business is when you do stuff for profit. When you tell the story of your business, you're going to be telling it to one of a few different options. Internal users want to hear your story based on the language of managerial accounting. External users want to hear it based on GAAP, and the government wants to hear it based on the tax code. For more videos like this, visit accountingwit.com.
So accounting is defined in your textbook as the process by which financial information about a business is recorded, classified, summarized, interpreted, and communicated to owners, managers, and other interested parties. This is a good definition that captures the explanation of accounting in the previous video. And another way to interpret this definition is by remembering that accounting consists of three activities, and that is identification, recording, and communication. As a starting point to the accounting process, a company or a business identifies the economic events relevant to its business. And by economic events, please keep in mind that it only applies to events that are expressed in money terms. Some examples of identification include the sales of goods sold, or the sales of goods for a particular retail store, or a service provided by a business like legal services or insurance policies. Now, once the economic event is identified, the company records those events in order to provide a history of its financial activities. Recording consists of keeping a systematic, chronological diary of events measured in dollars and cents. We will learn how to record these events throughout the course, okay? Once events are identified and recorded, the last step is communication. Businesses or companies communicate the collected information to interested users by means of accounting reports. And you will learn to compile those reports in this course by completing what we know as financial statements. Now, when considering the three activities in the accounting process, we must also consider the following assumptions, which include the monetary unit assumption and the economic entity assumption. The monetary unit assumption requires that businesses or companies include in the accounting records only transaction data that can be expressed in money terms. This means that in the accounting world, we cannot record events like the quality of customer service, for example, since this cannot be measured in money, in terms of money. What we must record are things like payroll, electricity bills, the purchase of goods to be sold, etc. The economic entity assumption requires that the activities of the business or company be kept separate from the activities of the business or company owner. So, for example, if you are the business owner, you must keep your living expenses separate from the accounting records for your business. This means that if you use the profits for your business to pay your home mortgage, for example, you cannot record the mortgage payment as part of an activity in your business. This type of a transaction must be separated from your business accounting. The short video that was shown to you earlier explained the different entities that are interested and use accounting data. So the financial information that these entities need depend upon the kinds of decisions they make. For example, we have here internal users. Internal users are managers who plan, organize, and run the business. And these may include finance directors who are interested in knowing if the business or company has sufficient cash to pay dividends to stockholders. Basically, what they want to know is if the company or business can pay the bills. Then there are marketing managers who are interested in knowing the cost of goods to be sold in order for them to determine a selling price to make a reasonable profit. Then there are human resource directors who are interested in knowing if the company can afford employee salaries, in this case salary increases. And then there are management supervisors who are interested in knowing which product sells the most or which product is the most profitable. Then we have external users, and these are individuals and organizations outside a company who want financial information about the company or business. So the two most common types of external users are investors, and then we have creditors. Investors use accounting information to decide whether to buy, hold, or sell ownership sales of a company or stocks, while creditors use accounting information to evaluate the risks of granting credit or lending money to the business or company. So now we're talking about like banks. So the information that an accountant formulates will depend on the user that is requesting it, okay? When a business can be the businesses can be registered in three ways, and these will include either proprietorship, partnership, or corporation. So when a business is identified as sole proprietorship, it means that the business is owned by one person, and in this case, the proprietor receives any profits, suffers all the losses, and is personally liable for all debts of the business. When the business is owned by two or more persons, the business can be registered or identified as a partnership. And like proprietorship, the partnership receives any of the all the profits, suffers all the losses, and is personally liable for all debts in the business. A corporation, on the other side, is a business that is organized as a separate legal entity under state corporation law and has ownership divided into transferable shares of stock. So the holders of shares, or the stockholders, enjoy limited liability in this case. So in other words, they are not personally liable for the debts of the company or the entity. So speaking of businesses that are on the stock market, these businesses depend on investors. Investors want to make sure that they invest in a company that is profitable and financially sound. So this is where financial statements come into play. One question is, so how do investors know that the financial statements are accurate? So this video will talk to you about some cases that resulted in the Sarbanes-Oxley Act, which was set into place to assure financial accuracy and also to prevent fraud. So let's take a look.
In late 2001, people began to notice some accounting irregularities with a large publicly traded company. The company had a national reputation for consistency in both good times and bad, so it was considered a blue-chip stock. The name of this company was Enron. Within weeks, the stock went from over $90 a share to being nearly worthless. This occurred because the management team tried to cover up losses from the previous years by altering their financial statements. The deception that occurred gave the public a reality check, and in effect, investors started taking a look into the financial records of other large corporations. The Sarbanes-Oxley Act was introduced into Congress by U.S. Senator Paul Sarbanes of Maryland and U.S. Representative Michael Oxley of Ohio. Their intention was to create a law which would restore the faith of investors back into corporate America. By imposing stricter standards on financial reporting, there would be an increase in the reliability of the financial statements created by any given company. Let's take a deeper look at what the Sarbanes-Oxley Act includes. First, officers of the company are required to sign financial statements for accuracy. This holds them personally accountable for any misrepresented data. Second, an increased fine and/or prison sentence was set for individuals who attempt to defraud investors or misrepresent actual figures. Third, the company must provide a description of its internal controls. This is an attempt to increase the confidence of the public in that organization, while allowing them to gain an insight into the company's procedures. Fourth, the
company is responsible for hiring an independent accounting firm to come in and audit the accuracy of their financial reports. The financial reports are now required to have a section dedicated to the auditor's opinion as to the accuracy of the figures presented in the reports. Fifth, the company is now mandated to report all off-balance sheet transactions on their reports. Finally, the Securities and Exchange Commission is given more power to look into companies that are suspected of wrongdoing. The SEC will now do random reviews of companies to ensure that they are complying with the Sarbanes-Oxley Act. Their reports are then published and released to the public for viewing. The SEC is a special division that is designated to work with Sarbanes-Oxley issues. This division is called the Public Company Accounting Oversight Board. We hope this video helped to educate you on the world of Sarbanes-Oxley.
So, the accounting profession has developed standards that are generally accepted and universally practiced. This common set of standards is called Generally Accepted Accounting Principles, or GAAP, and these standards indicate how to report economic events so that business financial information is shared in a uniform manner. So, the primary accounting standard setting body in the United States is the Financial Accounting Standards Board, while the Securities and Exchange Commission is the agency of the U.S. government that oversees U.S. financial markets and accounting standard setting bodies. And so this wraps up the material covered in Chapter 1. Please remember that I am here to help you succeed. If you have any questions or concerns, please set up an appointment with me for office hours. Send me an email or text me. And for now, please make sure that you read the chapter and complete the assignments for this week, which are in Module 2. Thank you for your valuable time.